right, welcome everybody. As you guys, I hopefully know, this is Chris Lutz, the group chair, and I am Sam Breslow. We are going to give you guys a national case update today. You want to click through to that, to our agenda, Chris? But yeah, welcome again. Really exciting to have everyone back in person. Our last summer event was, I guess, 2019
yeah.
at Ballast Point, which was a little tight. We got some space today to spread out, but this is a phenomenal venue. And I hope everyone's going to play some ping pong later. I think Chris has been trash talking.
Yeah, I'm a total ringer, you know.
I can see him like suddenly, sly skill of ping pong. He just like is talented at everything for no reason. But yeah, so our agenda today, after I gave Chris a little compliment to get his ego going for this, we're gonna, where every case starts, Nexus, talk about some recent Nexus developments. First on the income tax side, then on the sales and use tax side. Go through some big income tax developments, which really primarily have been gains on sales of ownership interests. Tons of M&A activity over the last couple of years, and what comes with that is all of these cases dealing with how do you source the gain from the sale of an ownership interest.
Or should you pay tax at all?
Yes, and Chris is going to talk about a couple other apportionment issues as well. And then we have some sales tax developments, which I will say these income tax cases, Metropolis, Fast Holdings, you've probably heard about them once, twice, a handful of times. The reason is they're big cases and they're really important cases, and we will talk about them again today. These sales tax cases are cases I haven't necessarily seen as much activity on. There are some smaller cases that are pretty interesting. So definitely gonna.
Well, and I think part of the goal here with doing this national update isn't to give you, here are all of the developments that have happened in the past 8-9 months, right? I think it's really to try to give you guys a snapshot of the controversy and legislation that we're seeing that really relates to some of the biggest topics we're seeing that are relevant to clients. So like if we were to distill this presentation into what are the two major topics, it's differentiation among like what you're selling for sales tax purposes. Is it software? Is it a service? Is it tangible? And then on the income tax side, the withholding on sale of like flow through entities, various types of sales of equity interest, things like that, that has been huge. So those are going to be the two major points of conversation today.
Can you guys hear Chris, or does he need to put his mic closer to his mouth?
Eat the mic.
Okay. So let's start with 86272.
That's a lot of words.
That is a lot of words. I'm going to identify a few of the biggest examples. I think some of the more interesting ones. So 86272, is a protection against tax on net income for sales of tangible personal property, so long as the activities don't exceed solicitation. That's the baseline rule for 86272. Which has been around for a long time. Back in 2021, the MTC published some specific rules with respect to internet activities. And you've probably heard about this because it was a huge change, but also was sort of a sword to this rule that was already questionably effective. But now, if a state does adopt these unprotected activities in terms of internet activities, then it's going to be pretty ineffective as a protection against a net income tax. Some of the big ones here that I want to touch on. The first is answering customer questions. So what it identifies as a protected example would be a static, frequently asked question on a website. So you look on the website, it has some FAQs and some answers. That's something that's still protected. Something that's not protected is you go into a website and there's either a chat function or just an email link that you can click on that allows you to interact with a business. That now is no longer protected.
And how is that different than a 1-800 number? A phone call that you can place, that still remains protected. And I spoke with the guy who wrote this recommendation up, Brian Hamer, at the MTC. And I brought that up to him and I said like, hey, I can go into the yellow pages and I can call somebody and I can ask about the product, and that's not going to kill it. And the reason is because when Public Law 86272 was written, you could have called and everybody assumed that that phone call would have remained protected. And all he did was give me kind of a sly smile and say, yeah, we chose to not address phone calls.
Yeah, because they know what they're doing. They're pretty much eliminating 86-72. But the next example I want to touch on are cookies, which Massachusetts, I think, paved the way with sort of cookie legislation. But what they say here is if the cookies are in the nature of soliciting a sale, so if it helps you remember what's in your cart when you were going to purchase something, or if it reminds you later on, those things, those cookies, still protected under 86-72. However, if those cookies do something more, like allow the business to gather information on their inventory or to create a new product, if the information that's gathered by those cookies allows them to do that, then that activity is no longer protected. I'm not sure if really any business delineates between the two.
No.
I'd be curious to hear from a company that does, but I'm guessing they have both types of
Once you're in the
cookies.
business of using cookies, you're going to cross this threshold almost in every instance, I would say.
And again, would be curious to hear of a company that doesn't use cookies, because I think it's wildly important if you have some sort of online purchasing platform. You know, the last is selling products online. So if you have your own products on your own website, that is still protected. However, if you use a marketplace facilitator to do that, that's no longer protected. And again, if you're selling products, you're probably using somebody like an Amazon or eBay that has the requirements inventory throughout the states. But I don't even think you can delineate between where that inventory is really located.
I am 100% relying on 86-272 if I'm a marketplace seller. There's no question. The one that really pisses me off that hasn't gotten a lot of attention is if you can apply for jobs on a company's website. What? if you can apply for a non-solicitation job on their website, but then you're not going to do that non-solicitation job in that state, you're going to like move to the state where the job is located. That is unprotected under this guidance. I would suggest that what they've effectively done here is rendered 86-272 completely pointless, and somebody's going to fight it and challenge it. The question is, what will the stomach for courts be that do, you know, hear that challenge? Because we all know post Wayfair, limiting jurisdiction does feel like a bit of a relic, to which I say fine and get rid of 86-272. I think all of us are of the opinion that 86-272 either needs to be updated or gotten rid of. That said, for so many of our clients, and I'm sure a lot of the clients in this room, we're seeing them hit these Wayfair thresholds all over the place. We're seeing these huge multi-state registration projects. At least we don't have to register for income tax because these are online sellers and things like that. And I'm going to dig my heels in the sand. You know, sometimes we say, well, you know, you got to tell them what the law says. And, you know, yeah, you do have a filing obligation. I disagree. I disagree with this guidance. I do not think it's allowed to trump 86-272. And I don't think it's worth the paper that it's written on.
To Chris's point of where are we going to see this challenge, the question is, where are the states currently? So California has issued an advice memorandum. They didn't adopt the law. They took kind of a backdoor way into this and just put out a publication that pretty much follows the MTC's guidance. New York is currently going through the regulatory process, so they are going to adopt a regulation. Currently up for notice and comment, so if you want to pester New York with some of your thoughts on this, maybe Chris should put his anger into writing these New York comments, which the deadline I believe is August 26th to submit comment for that. The next two states are, looks like, going to be New Jersey and Oregon. So New Jersey said that they're pretty much going to be the same. They're going to follow this more or less. Their language was a little bit tepid. And then Oregon I think is a little bit interesting because the current hearing officer for the MTC was previously at the Department of Revenue for Oregon. And when he was at Oregon a couple of years ago, he put in a letter to the MTC about this, providing comment, and said that he didn't necessarily agree with it and thought there should be more examples. So I think what that means is we're going to see something similar to this in Oregon, but probably with a lot more examples, which, I mean, you can already see it's kind of flesh with examples. It's not the examples that are the problem.
No, it's the theory. They're pretending like they're faithfully construing 86-272 with modern technology. But the problem is that that's not really what they're doing. If you earn revenue from sales of services, that's when you don't have 86-272 protection. But I think we should probably move on to the sales tax side.
I guess one more thing is throwback. So as angry as we are about 86-272 and how it might no longer be effective, the good news is a state like California does apply throwback. So to the extent that you are now determined to be taxable in a state because your activities do more than all of these obvious things, well, now you don't theoretically have to throw the sales back to California.
And then that's going to get into the issue of, are you actually filing, or will you just say, well, California, we're using your law, and we're avoiding throwback using your law, regardless of whether we're filing. 2 cents on throw out and throwback. I think that those are also completely antiquated concepts that we shouldn't have to follow either.
The next, so as Chris said, we should get into Nexus for sales tax purposes. So what's been happening here? Well, you guys know that Wayfair happened, and then every single state adopted a Nexus threshold similar to the 100,000 receipt, 200,000 or 200 transaction threshold set forth in Wayfair. I will say the one caveat to this is technically Missouri's is not effective until January of 2023. I don't know why they did that. They gave themselves 2 years to miss out on revenue, but technically not yet effective. But there are, we are going to see challenges to Wayfair, even though that is a Supreme Court ruling. And one of the first ones we see in here is this UMA decision. So UMA provides VoIP services. They have somewhere between 6,000 and 13,000 customers receiving VoIP in the state of California. I don't know why that's such a big range, but that's what the case said. Between 6,000 and 13,000. They don't have any employees, no physical presence in the state.
Oregon.
Oregon. Oh, sorry, you're right, Oregon. My bad. Can't read. Yep, it is Oregon, the Oregon Supreme Court. And the question was whether they have Nexus. And UMA raised a pretty interesting argument that was posed by some dicta in the Wayfair decision. So in the Wayfair decision, they didn't just say you have to have economic presence. They said you also have to have virtual presence. And I do kind of want to, touch on this because I think it could be another way that taxpayers challenge this. The difference between someone like UMA and a Wayfair is that Wayfair makes sales through an online platform. Customers have the ability to go on and access that. UMA is just a seller who, for all intents and purposes, all the actual hardware was being provided by a third party. There's no ability to access that website by their customers in any state.
There wasn't a website.
Correct. And so their point was, well, there has to be some meaning to that language in the Wayfair decision, the virtual contacts language. And I think what that means is that we are a distinct business. I think for other reasons that I'll get in this Halstead Bead case, there are other ways to distinguish a company, which is based on size as well. Wayfair is a mammoth beast of a company versus Halstead Bead, a small mom and pop. But the point is, the court didn't hold for the taxpayer. They said, we're not going to buy into this virtual contacts argument, which, I think this was just kind of, we all sort of saw this in the dicta Wayfair. We're wondering who's going to raise this, but unsuccessful.
Well, and to that point, I think that the point of emphasis here is that Kennedy's decision in Wayfair basically says we're getting rid of a bright line nexus standard. It's no longer just physical presence, right? But what states have effectively done is they've taken that South Dakota legislation, the $100,000 to 200 transactions, and they've replaced one bright line standard with another. But that's not what Wayfair says. If you go to the penultimate paragraph in Wayfair, he says, but there could be some other Commerce Clause challenge against the state's assertion of nexus, right? And then he gives 4 different reasons as to why he thinks South Dakota's was acceptable. But their point here is a good one. You just spent tons of pages in Wayfair saying how they have this virtual storeroom, this virtual store where you can even do more than you could do in a brick and mortar. UMA didn't have that. All UMA had was a bunch of sales. I think UMA is wrong in this case, and I think they'll lose and their petition for cert will not get accepted. And the reason I think that they were wrong was I don't agree with Sam's characterization that Wayfair says you have to have a virtual and economic presence. I think what they were saying was Wayfair had a virtual and economic presence, but each case requires sort of a facts and circumstances question as to whether the assertion of nexus in the case satisfies sort of like the minimal context of due process and whether there's something sort of discriminatory that runs afoul of the Commerce Clause. I think that's really what they said.
Here's the exact language from Wayfair.
Yeah, go for it.
I agree with you, but it's here the nexus is clearly sufficient based on both the economic and virtual contacts respondents have with the state. I see your
here.
Point. Yes.
Here.
It's the here.
It's in this case.
But they do
this fact and circumstances.
Both.
And yeah, no, because they had both of them. Here, though, in UMA, they had the substantial economic nexus. They had continuous maintenance of contracts with people in the state, and they advertised substantially to them. I think that was a big point in the UMA decision.
It was. And so SCOTUS did deny in June. So it's.
And I think that the Supreme Court's going to deny just because they're not ready to take a re-examination of Wayfair so soon after it.
But to Chris's point about the 4 guardrails that Wayfair established, so yes, the threshold was one of them. Another was that you are a member of the Streamlined Sales and Use Tax Agreement. Another is that you have software for taxpayers in the state that allows you to file a regular return. And that's where this Halstead-Bede case comes into play. So I'm sure you guys have done something in Louisiana and dealt with their 62 parishes and the fact that these local taxes are not administered on the state level. They did come up with a streamlined program, I think back in like 2021, might have been 2020. But the localities, the parishes don't have to participate in the program. So it's still wildly ineffective. You've got a local taxpayer here, Halstead-Bede, who is having to file a bunch of returns in these 62 states. And the question is this an undue burden? One of the problems of the Commerce Clause is that it can't infringe upon interstate commerce. It can't be an undue burden. And I think this is. And this case was dismissed for silly procedural grounds. The fact that it shouldn't be in federal court. I'm not going to bore you with procedure. But I agree with Chris that I think this is the stronger case. A state can't just run amok with a threshold and say that's enough. You have to abide by, yes, the other guardrails set forth by Wayfair. You have to make it so it's not a very, very expensive endeavor for a small taxpayer to file in the state. So Halstead-Bede is going to be, I guess, it could still be appealed.
There's a lot of procedural problems with it being in federal court. I don't think we need to get into
but we'll
here.
See somebody else.
But by way of example, I had a client just yesterday come to me. We've done analysis for them, decided they're a professional service company. There is a software component, but they're a professional service company. A customer of theirs reached out to them yesterday and said, hey, just so you know, we're being audited by Colorado Springs. And they're saying that we think it's SAAS. So even though Colorado doesn't tax SAAS, though Colorado agrees it's professional service, Colorado Springs disagrees and thinks that you have a collection obligation.
Yep.
How is that not a burden on interstate
For Colorado
commerce?
purposes and Louisiana purposes, there could be an exemption that applies at the state level, but not at the local level.
And then I have a local filing obligation in Colorado Springs.
Yeah.
Absurd. That
That was actually one of the points Race and Halstead as well, is that they're a wholesaler. So they could actually have no taxable sales in these localities, but still have a filing requirement. It's nuts. But yeah, I agree. Colorado is definitely the ones that it's hard to come up with a good compliance plan for a taxpayer. All right, trivia time.
tote bag up for.
I think this is a gimme, but we'll see. I mean, I think every single article I've ever read about 86-72 starts with this. So Congress adopted Public Law 86-72, and so I made it a little bit harder. What year and following what decision? Laura, was she the first? 59. Yep. And what was the case? No,
nope.
Not Quill.
You'll still get a tote bag.
Yeah.
So we've got.
She got 50%.
We've got 1959. So what was the case? Quill is 1992. The case.
All right, it's harder than I thought.
Oh, geez, Sam.
I should have gone with the year.
Northwestern Portland Cement. I'm taking a beanie.
All right. So our first income tax case, which is one I've seen a lot of activity on recently with my clients. So this Metropolis case, which was decided, I think, back in May at the California Court of Appeal, and is currently being appealed to the Supreme Court. Which
does not take cases.
Yeah, we did submit an amicus letter, as did a bunch of different taxpayers and firms, in support of this case being taken, or depublication, because it's just a rough decision. Yeah. So fine, don't take it, but depublish it, so we're not.
That would probably be the better outcome. I was talking to Marilyn, who has a lot of cases in California, and she said they pretty much only take murder cases at the Supreme Court, right? Yeah.
That's a good one. Yeah, I don't know whether it's going to be taken or not, but let's talk about this Court of Appeal decision. So you have Pabst, which is an S corporation, and owns 100% of PHI, also an S corporation. Pabst sells all of its interest in PHI, and then that gain, which is an asset sale, the gain passes through to these non-resident trusts. The gain is treated as intangible goodwill because it's an asset sale. For entity purposes, PAPS apportions 6.6% of the gain to California. On the non-resident trust shareholders returns, they also apportion 6.6% of the gain to California, but then they go back and amend it. And they say, you know what, we really shouldn't be taxing any of this in California. Really, so our question is whether a California non-resident trust, and then therefore its individual shareholders, whether they can be subject to California income tax on income that's derived from an S corporation's sale of intangible property. So the sale of goodwill. There's really two lines of argument here. So the taxpayer's argument is that there is this statute section 17952. I don't want to say 17952 over and over again, so let's just say the statute, because I think that's important. It is a statute. So there is a statute in California that says the intangible is sourced to the location of the situs of it.
And importantly, that's for individual income tax.
So they say, you know what, and for purposes of this case, we don't care about the entity. We're just focused on those individual shareholders. So they say, yeah, let's look at the Personal Income Tax Act, which is a statute, and the business situs of this property, which is based on the owner's location, according to them, is not located in California. This is a rule of allocation. It's all or nothing. So we don't think any of it should be allocated to California. The department's position is that there is this catch-all provision in the statute, 17954, which I do kind of want to read that section. I think I have it here, which, gross income from sources within and without the state shall be allocated a portion under the rules of the FTP. It's just kind of like a catch-all. And then instead, they're really relying upon a regulation section, which again, I don't want to say a bunch of numbers over and over again, so we're going to call it the regulation section, but if you really care, it's 17951-4. And that rule says if the gain from a sale is both within and without California, then you are going to source it based on your DIPA. So what the department has done here, or what they did on their original return, is correct. This amended return is incorrect, so it should be apportioned using that 6.6% factor. There's a few concerns with this case. One is that the Court of Appeal of California puts a regulation above a statute, and I can already see Chris itching, but I again want to read the language because they really do. They say the opinion states word for word. The regulation is not subordinate to section 17952. And if the two provisions are irreconcilable, the regulation governs. And the reason is that the regulation is specifically for an intangible versus the statutes for an individual. So there are some serious concerns here with the fact that you should never allow a regulation to trump a statute. You shouldn't allow an administrative agency to serve as the legislature. It's pretty concerning. The other is they've transformed this rule of allocation to a rule of apportionment. The taxpayer's position is this can never be within and without because it's a rule of allocation, so we shouldn't even be doing that analysis. As I mentioned, again, the next steps are appeal. This definitely has a ton of implications for individual shareholders that are located outside of California, and with all the M&A work, a sale of a partnership interest.
I think Metropolis was correctly decided. I think it's a good argument. Certainly the idea that, look, the individual is ultimately paying the income tax, we should use the allocation rules for individuals. It makes sense. But there is ambiguity when we're talking about selling an interest in a pass-through entity under California law, right? I think it's incredibly reasonable to say we use the attributes of that entity that is being sold in order to apportion and allocate. And California law, unlike a case we're about to talk to in a second, has support for that. Not only that, even if we followed the individual income tax rules in California, the whole concept that, well, it's an all or nothing, it's the location of the investor approach is not supported by California law. It would also be totally reasonable to say that the intangible, i.e. the goodwill associated with the sale of this flow-through entity, has obtained a business situs consistent with its sales factor. That would be a reasonable approach for the FTB to take. And the taxpayer didn't have a really good argument against that, other than just sort of common law, doctrine that when sourcing and allocating for an individual, you go to their state of residency, but there's no actual support for it under California law. A few other things here. Where did the taxpayer go wrong? It's a refund claim. You really think they're going to get the refund rewarded to them, right? I had a call this morning, sort of similar fact pattern. And I said, no, we're going to say you're not unitary. You're not unitary. We don't get there then, right? We go down the individual income tax route. We're going to say aggressively, yeah, you know what? I am going with my state of residence. They're Tennessee residents. Okay, we're just not going to file. So whether we, you know, if we went up to the Court of Appeals, would they say you're Metropolis and that governs? Maybe, but I have a feeling we're not going to get caught. So we've got legitimate arguments. We're not going to file a refund claim. But also, I see far too often now taxpayers just saying, yeah, you know what? Shucks, we owned the company. We're unitary, right? Well, I say push back on that. Are you unitary? Do we have to get to a characterization of business income to start with? If we know I'm going to go into a state and say, fine, I'll concede the business income, but give me some sort of denominator relief. They're not going to give me that. So if I know they're not going to give me an inch, why am I going to give them an inch on the other side? You know, take an aggressive non-unitary position, take the individual income tax position should apply, and here's why. And it's certainly a reasonable position to take. But, you know, if you're publicly traded, get a reserve.
One more thought here. I guess the reason why depublication, why that could matter. So there was actually a decision, I don't remember, do you remember what year venture was, Dave? Like, I'm going to say 92. No one knows if I'm right or wrong. Venture communication was decided for the taxpayer. Pretty much the same set of facts here, but it wasn't a published decision. So the taxpayer couldn't rely upon it. So again, we want this to be depublished so the department can't rely upon this in the future, even though we know that this is what California is going to decide. And
one point that this is really lawyer nerdiness getting into the weeds that maybe nobody in this room cares about, but something that this case, the last case, and sort of a lot of the cases we're talking about in the income tax context have really been hinging on lately is this extent to which the courts should defer to departments of revenue, to the extent to which the courts should defer to a regulation. By way of example, just really quick, going back to California, you have an occasional sale, you sell a bit, you have a huge capital gain. They're saying that's business income and it's excluded from the factor. But it's only excluded from the factor pursuant to a reg. The state statute says gross receipts go in the denominator, right? In my view, when they exclude that huge gain from the denominator, California is invoking alternative apportionment, not me. And they've got the burden to prove that it should be excluded. Well, there's this SBE ruling called floor in which the SBE said, no, the regulation has modified the statute in such a way that the standard apportionment formula incorporates this regulation invoked by the FTB. So, and now it is your burden to show that our creation of this alternative method is distortive in some way. I think they're wrong, but that's what they've said. Other courts, like the American Honda case in Arkansas recently, have said, we don't even look at the regs if we can review the statute de novo and we think it says if we agree with what you say. We won't even look at the reg, right? So I think that's really important. It comes into play here in Vast Holdings. Vast Holdings, similar kind of concept as what Sam was just describing. We don't really have the individual income tax versus corporate income tax problem here. What we have, though, is you have parent goes out, acquires a sub, creates a new entity based on the merger with this new sub, right? And then 3 years later, sells this sub for a $30-something million gain, says none of it should be taxable in Massachusetts. Massachusetts says exactly what California was just saying. No, that sub was operating in Massachusetts. Therefore, we should take the gain, we should take the apportionment factor of that sub, and you should owe income tax based on that amount. And they say, Vast Holdings says, no, this has to do with us as the taxpayer and our apportionment methodology and our presence, and we conduct zero business activity in the state. So notwithstanding the fact that this sub that we sold had business activity, we don't have business activity. We are not a taxpayer conducting business in Massachusetts, and we don't owe you tax, right? At the lower courts, this was litigated exclusively on a constitutional basis. The taxpayer saying, constitutionally, you may not reach us because we're not conducting business in Massachusetts. Massachusetts argues back, constitutionally, we can tax you because this thing you sold was in Massachusetts, right? Conducting a substantial amount of business. The court never should have answered that question, never should have answered the constitutional question, but they spend like 10 pages on it, right? And what they say is, the department's right. constitutionally, that entity that was sold has contacts with the state. There's nothing about due process. There's nothing about the Commerce Clause that prohibits Massachusetts from taxing this, right? But then they go on and say, however, Massachusetts law doesn't tax this. Massachusetts law is very clear that you look to the attributes of the taxpayer, not the investee, I'll call. So investor versus investee. You don't look to the investee, you look to the attributes of the investor. That investor does not conduct business in Massachusetts, therefore you cannot reach them. You could have done it, but you didn't, right? So that's an important distinction, because following a very similar law, the Petershill Goldman Sachs case went the opposite route with respect to the New York City General Corporation Tax, a vestige of pre-2015 law in New York, also still applicable to S corporations that are operating in the city. They're very aggressive with respect to the application of the GCT. Although we've had a little bit of success with the conciliation conferences over there, just their audit team, the inmates are running the asylum. But so it was the same question, right? We sell this investment vehicle that is doing business in New York City, but we don't. We're entirely British. We have no connection to New York City. We sell this entity. The city is saying we use the attributes of that entity, and you have to pay tax on the gain based on the attributes of the investee. Same concept, right? But New York City, construing an almost identical law, said, investor, you were conducting business in the city because you had a partnership interest for an entity that was conducting business in the city. They call it the conduit theory. You were doing business by virtue of the activities of the partnership in New York City, so they could tax it. So we've got two very similar laws, two different answers. And Goldman Sachs was very ably litigated by a great lawyer that we're very good friends with. They actually had to argue multiple times and kept trying to attack it from multiple angles, and they kept losing. So at least in New York City, general corporation tax, it's a rule of, feels like this one off. It's a rule of limited applicability, but it still is a rule that a lot of people are paying attention to. And it's one in which substantial deference was afforded to the Department of Taxation.
Even though vast holdings went for the taxpayer, unlike this one, it's still not very satisfying because of what Chris had said. They seem to suggest that from a constitutional standpoint, it could fly, which sets up another challenge of the open question left by Meet West ACO. But it also tees up Massachusetts just to adopt a statute, because their holding was, well, the statute doesn't allow you to do that, so we're not going to allow you to. So now Massachusetts, assuming the legislature get their act together, are just going to adopt a statute.
And this hits close to home. So New York State had an allied signal case. So I'm not talking about the one that goes to the Supreme Court, but the one that stayed in the Court of Appeals in New York that said the same thing, pretty much that Goldman Sachs is saying here, right? We had a case in Illinois where the department was saying for corporate income tax purposes that there was no requirement for a unitary relationship between the member and then the LLC that it sold when that LLC had business activity in Illinois, right? That is 100% false. And we got them to basically agree. We paid them a nuisance settlement offer to make them go away, but they forced us to go to court. And I have multiple write-ups from the Department of Revenue saying that in that context, a unitary relationship is not required between the seller and the sellee, so to speak. So they're looking for a case in Illinois on the corporate income tax side to try to hit this. So just so you're aware. So yeah, moving a little bit away, because I want to make sure we do get to the sales tax updates. Just a few other updates that don't sort of fall within what I think is the most important thing that we wanted to talk about, which is the sale of equity interests. We've got the RJ Reynolds case, just kind of an interesting one, thinking creatively. Virginia has a 3-factor apportionment: sales, property, payroll. RJ Reynolds Tobacco Company would store a bunch of its tobacco in Virginia in warehouses and storehouses to age the tobacco, right? It would then subsequently distribute that throughout the United States for processing and ultimately for sale. The Department of Revenue wanted to include the value of all of that tobacco sitting in Virginia warehouses, and in fact cited to a regulation they had, which referred to inventoriable goods in process. So the regulation actually uses the word inventoriable, which I do not think is a word. But the idea being that if you have inventoriable products in the state, that meaning ultimately it will be good for sale, that's included in the factor. The court disagreed. The court said, no, you have to use the property. And right now what they're doing is they age this agricultural product. It doesn't constitute use in the state.
Storage is not used.
So, well, storage could be use. It's just not use here because of the aging element. If they were storing it for sale, it could have been considered use. We debate this all the time. What is use?
On the sales tax side.
Yeah, what is use and how aggressive can we be? It has to mean something, right? Because if they say for use in the state, it implies that, well, it can be in the state not for use, right? And is storage use. But anyway, so they kicked it out of the property factor, and that resulted in a substantial reduction in Virginia taxes, one can imagine. Again, not a rule of huge applicability, but it's important. And again, going back to my theme on like deference, it seemed like the department had a regulation on point, and the court said, no, we disagree. Use is not something we need you to define for us. Bethesda. So this is, I mean, does anybody even remember how to do income producing or cost of performance anymore? Some states still have it. Some states still have it. So what we had here is a pretty complicated structure that I'm going to boil down and not correctly describe, but I think it's useful at least for purposes of our discussion. It used to be with like cell phones and stuff. I lived in England for a while, and you would like top up. So it's kind of the pay-as-you-go cell phone model. This company, what they did was basically the payment processing that allowed you to up your minutes, you know, to pay as you go with your phone. What they used in doing this is sort of various network of independent contractors that they called payment acquirers that sort of functioned as middlemen between the telecom companies and the banks. So the question was, when they used these third-party payment acquirers, was that a cost of performance? Did it belong in the denominator for purposes of calculating their income-producing activity? They said it certainly does. But Oregon and the Oregon tax court disagreed and said this is not a direct cost. This has nothing to do with what you're selling or what you're doing. These are third parties that are going out and doing this sort of on behalf of the banks, if anything. It was kind of a weird case, very in the weeds that I don't think we need to spend on now, but it just goes to show that we're still litigating cost of performance in income producing cases in 2022, when I think almost every presentation you would go to on the income tax side now is going to be exclusively concerned with market-based sourcing. But we still have almost 20 states, 18, 20 states that are income producing states. So with that, I think it makes sense to kind of pivot over to sales tax.
Yeah, we wanted to spend a little bit more time on the income tax side since this is probably the heaviest for income tax today. So moving to the sales tax side, this first case that we're going to talk about is a bank who buys software, that's up for debate, buys software from a company called Fiserv. And what Fiserv does is it allows you to sort of maintain records. So if you went into a bank and you made a deposit, Fiserv software would then store that for you within their system. And again, another refund claim. Don't pay tax on something and then seek a refund claim. You're gonna lose, and as the taxpayer does here. So originally they treated it as canned software and taxed it, and then sought a refund claim on the basis that no, actually what we have here are non-taxable personal or professional services. And we have a Board of Tax Appeals, a lower decision that agrees with the department that this is canned software. And then the higher court says, all of you are wrong. None of that is right. In fact, what we have here are really multiple. You have automatic data processing services, which are taxable, electronic information services, which are taxable, and then maybe these personal professional services. But that's not the true object of what we're doing here. And the taxpayer's argument for why they thought it was personal or professional services was because the software replaced the individuals within their department that had to do that. It's an argument, but I don't think it's a necessarily a good one. But the point of this case is something that Chris and I have seen a lot with software companies, or maybe companies that just use software to a service. I think what you have to ask yourself is, are you selling software? Are you selling software that performs services, which is what the court ultimately decided was happening here? Or are you selling a company that performs services but just uses software, which is something that we deal with a lot. We'll often see companies that are doing a reserve analysis and they'll say, there's software, that's taxable. Let's look at the smart chart for SAAS. Okay, it's all taxable. But you have to actually analyze the invoices and the agreements, which they did here, to see what are you actually selling. And often it may just be a company that uses software to perform a service. And in that case, I think the true object is not actually taxable software or a taxable service as it may be, like automatic data processing service.
Yeah. Yeah. No, it's become, how many companies come to us and just say, we're a SaaS provider. We're the Uber of blank, right? Mm-hmm. And it's like, no, that's not how we're describing you at all for sales tax purposes, right? Yep. It's far too frequent. So many times an auditor will just look at their marketing materials and we'll be like, but you got to look at the service agreement. We don't even have a licensing agreement. You got to look at the invoice. They're not even paying for a license. You know, how could it be SaaS? They market themselves as SaaS, sure, because it's sexy, you know, but why, I'm not sure. But
yeah, I mean, I can't emphasize enough how important the agreements and the invoices are and how they characterize something as to whether it's taxable or not. Next case, I think is a good example of why you shouldn't litigate a case pro se. Hire somebody like us or somebody else. This guy sounds like maybe he's an interesting guy, but he operates real properties as vacation rentals. So he rents out properties, and he charged a 4% credit processing fee. And I think this is another refund claim. It seems like both of these are refund claims. Yeah. But I think originally paid tax on it and then filed a refund claim on the basis that this credit card processing fee is not part of the sales price. And so what this comes down to is it is a separately stated credit card processing fee. Can that constitute part of the sales price, or can you remove it? The statute does define the sales price really broadly in Minnesota, and I think that's part of the problem, but most states kind of do. And it defines it as the total amount of consideration without the deduction for materials or expenses. What he creatively latched onto is there is an exception for interest, financing, and carrying charges from credit. So his argument, I think he just saw the word credit. It's like ding, ding, ding. But that's not really what they're doing. These credit card processing fees aren't financing alone. They're something else. So the court didn't allow the exclusion from the sales price for these. All right, this dynamic case. Another taxpayer loss. I do have one taxpayer win, so if we get to the end, we'll get a win. But the burden was pretty absurd on that one. Okay, so in this one, you have a case about the Washington B&O tax and whether it should be the retail or the service B&O. I think my takeaway from the outset is, so DRI, they're based in New York and they contract with different brands like Nike, Levi, to do displays. So you're walking down Michigan Avenue and you see the Nike store, they've got a really pretty display. They don't actually put the display up. They hire third parties to do that, to do the actual installation of the display. They're just sort of like the middleman between Nike. But my takeaway is on their questionnaire that they got from Washington, they just gave them everything. They said, oh yeah, we use third parties, they install it. Be careful with questionnaires. That's often where we see taxpayers getting in trouble.
Especially in Washington.
Yeah, absolutely. They're looking for you to step in something. So they disclose the fact that they use these third parties to do this installation of TPP. And the statute is pretty strict here. I mean, for the retailing classification of the B&O, it does, the exact language is charges made for TPP consumed in labor or services in installing, repairing, altering TPP. I think they're right. I mean, I think what they are doing here is they're installing these displays, they're altering the displays. The argument that the taxpayer made was that it's not permanent intangible personal property, so these displays are only temporary. But that's not based in the statute. That permanent language they got from, it was like a publication for interior designers. So, you know, publications can be helpful, but they can also get you in trouble if they stray from the statute. it's really merely an interpretation for a taxpayer. I would argue for penalty abatement, but I don't think that the taxpayer was right here. I think this is properly characterized as the retailing B&O classification, not the catch-all terms.
And just to clarify, anybody in this room worked with the B&O in the past? Show of hands. Yeah, we have. So the business and occupation tax is a gross receipts tax. Washington doesn't have an income tax. It has this gross receipts tax. But one of the problems and a real trap for the unwary here is that the B&O and the sales tax are really administered very much in tandem. In fact, the return is the same. It's the same return, right? And so sometimes there will be a disconnect between how people report their retail sales for sales tax purposes and then their classification for B&O, and you can get really tripped up there. So like if you're going to go in and say we are a service provider, for instance, which is going to be a higher B&O rate than the retail classification, be sure you've crossed your T's and dotted your I's and feel comfortable, because they're going to see those gross receipts on your return, and they're not going to see anything in the sales tax side, and it's going to trigger questions. They're going to want it to be a retail sale.
Yeah, I think what Chris is thinking of is a client that we helped with that was treating it as the sale of software, so SAAS, TPP. So they were paying under the retailing classification. We told them from a sales tax perspective, I don't think that's what you're doing. To the case earlier, I think you're really just using software to provide the service. So you really shouldn't be paying sales tax. But what that means is we also have to change it on the B&O side, because you should no longer be under the retailing classification. You should also be under the services classification, where they're going to catch you on that.
It'll be an automatic trigger.
Yeah.
So Blackman and Graham, this is an interesting one, and it feels a little too close to home. So it's a law firm in Texas, right? This law firm in Texas used a third-party service that basically would create these electronic bundles that allowed it to do residential and commercial loan closings, things like that, right? So they took the position on audit that they were not taxable because these were legal services being performed for them. Well, Texas has a sales tax imposed on information services and data processing services. For whatever reason, I'm not 100% sure why, it's only 80% of the base is subject to tax. So you get a little bit of a benefit, but Texas, along with, I would say, Ohio, is one of the most aggressive states with respect to their sales tax base for things that fall within this paradigm, within this spectrum of, are you a service? Are you software? Are you something else, right? Ultimately, the Texas, and I think this is a lower court, I can't remember right now, but ultimately the Texas court held that, no, this looks like data processing to us. So you can call it a legal service all you want, but they're taking all of these legal documents, they're consolidating for them, they're giving it to you, they're sort of white gloving it for you for these closings. And that's data processing, and it's subject to sales tax. Gets into really interesting problems, right? Because then what you're effectively doing is you're indirectly taxing the provision of legal services. And then we can get into the whole, like, well, do you have a constitutional right to legal services? All of that. I would say not really. South Dakota certainly doesn't think so.
I'm willing to be aggressive with characterizing something as a non-taxable service, but I'm not willing to do it in Texas.
Yeah, no.
They tax everything, and it's not the state you want to get into a battle with.
Yeah, in our view, what we've been wanting to do actually is use Texas as the counterexample. So the idea being, hey, look, we're not hiding from sales tax. We went to Texas. We told them we're data processing. We're not SAAS. They agreed with us. We're paying tax as data processor or an information service provider, although I don't like doing that because New York. We're a data processing service. And so look, we're not trying to hide anything from you. We just don't provide SAAS. And the states that tax this, we readily agree that we're taxable, right? So I think that's the way we've used it to our advantage a little bit. And the woman over there who oversees like voluntary disclosures and everything is one of the easier people to work with. At least she responds to emails.
Kentucky.
Yeah, so Kentucky, just wanted to throw this up there. Yeah, go ahead. Correct.
So, you know, it's separately stated, lawyers know, like, I felt like separately stated charge for all your out of pocket. So, I mean,
Not us.
Right, but a lot of, you know, so doesn't that raise, I mean, the question that was in my mind on that was, if they had not separated, would they have characterized
I think it would have been a use tax. I think that's how they would have done it. The question was, if they separately stated it, sure, that's easy to identify on the invoice to their clients. But what happens if they don't? If it was just sort of a lump sum, we only charge $7,500 for this project or whatever, then obviously the true object is not those forms or that piece. It's the provision of legal services. I think then what they would have done is they would have turned around and they would have said, you're the user then of that service and you owe tax. That would make the most sense to me. Yeah.
It really turned on separate states.
Mhm.
It really goes to watch that.
Yeah, sure. Although it's not unheard of, we've seen it for auditors to go after law firms and accounting firms on what are you guys using in terms of your software and things like that. You better believe we pay a bunch of tax on a bunch of the SaaS services we use to do our research.
So yeah,
I just wanted to touch on this briefly. I don't know if anybody has any concerns, clients, business in Kentucky, but we just wanted to throw it out there as states are really expanding their sales tax bases, both informally and formally. Kentucky has upcoming legislation that'll be effective at the beginning of next year that takes their list of enumerated services that are taxable in Kentucky, and it doubles or more what that list is.
it's so much that it took up 2 pages of my notes.
Yeah, so I didn't write them down because it would have taken up way more than this slide. But just throughout some things, just to give you a sense, like rentals, landscaping services, new types of telecom, pet services, laundry services.
I think the most important is pre-written computer software access services. And if you read the definition, I think they're targeting SaaS, so it's another state taxing SaaS.
Yeah.
One of them is testing, and I'm going to turn this into a
What is
question.
testing?
Yeah, honestly, if someone, okay, so it says that testing is everything except for medical, educational, or veterinary reasons. What other testing is there? If someone could give me one.
Give us an example and you'll get some shorts.
What other testing? Oh, Diane. Pre-employment testing, like drug testing?
Well, it could be drug testing.
Yeah.
It could be, Excel. If you know Excel,
Okay.
hire companies.
Yeah. Well, thank you, because that's been bothering me ever since I read this.
Yeah, and also, so like, well, they don't have a football team, but you know how like at the NFL draft, they do what's it called, like the Wonderlic test or
Yeah.
something like that? I guess that's kind of in
Sure.
theory what it is, but
Is that educational?
just wanted to put this up. Like Aaron Rodgers scored like the
It just shows a lack of
highest
it.
on it or something like that. Or that test that they give to police officers. Well, I don't know. They give tests to police officers, and if you score too high, you can't become a police officer. That was not meant to be a hit on police officers. I
You can
respect
beat Chris up
I respect law enforcement. So Apple, this is a weird case, and I guarantee somebody like me gave Apple the advice to do what they did. I'm just not sure how they got there. So what Apple was doing in New York was this promotion where you would come in, and I'm just going to use round numbers. You buy a laptop for $1,000, you get a $100 gift certificate in exchange, right? So Apple was treating that like, well, it's a $100 discount. So it's only a $900 purchase because, well, we're only bringing in 900 on this. You give us 1,000, we gave you back 100. So even though there was a $1,000 purchase of this laptop, they only collected tax on the $900. So New York comes after them and they say, no, that's not a discount. That's $1,000 laptop. And then when they go and they spend that $100 that you gave them, there will be tax on that too, right?
If you return the laptop, you're not bringing that gift card back.
Yeah, no, you're bringing that laptop back and you're getting the $1,000 refund. It's not a discount, but they were treating it as a discount for sales tax purposes. New York.
They also looked extensively at the agreements, which really emphasized the fact that it was, you will receive this, or you can receive this, you may receive this. It wasn't a guarantee within it.
And Apple's doing this in other states too, which is an interesting point. This is not something they looked at New York and said, oh, one off, we're doing it because New York law, uniquely provides this for us. Was it Maine?
Yeah,
I knew.
It wasn't a gift card. It was like cell phone discount. I think if you subscribe to the services, slightly different, but same concept.
Yeah, and so, nope, they lost. This was at the New York Supreme Court, which is not the Supreme Court in New York. It's the lower court, but on appeal from the Tax Appeals Tribunal, which they said, no, it's a purchase for $1,000. That's what the tax is due on it. like I said, somebody came up with this idea as sort of like a planning opportunity or something like that. I would not want to be that associate who wrote that memo.
Because yeah, now they're losing in multiple states. I appreciate the challenge, which I feel like usually a company like that doesn't want to put themselves in the limelight. But this is our one taxpayer win on the sales tax side. We have 5 minutes to talk about it. so sorry for a bunch of loss. The ultimate question here is printing, advertising, manufacturing. So to back that up, you have RTU, which manufactures cash register tapes. So the register tapes that restaurants use, or bars, or grocery stores, where I was a cashier at a grocery store and I always hated putting that tape in. It always jammed with like the meanest customer. But anyways, there's 3 types of register tape. So there's blank register tape, there's register tape with advertising of that customer, and then there's register tape with advertising of a third-party customer. And ultimately, the question was whether the manufacturing exemption was going to apply for, or really whether the electricity is exempt from sales tax that allows that manufacturing to be done. And they had a really sophisticated study that showed 67% of the electricity was supplying the machinery to do these printing tapes. But the department took a really bizarre stance in my view. They say, you know what, the blank tape, that's good. The tape with their advertising, that's good. But the tape with the third party, for some reason, that is no longer manufacturing at that point. Now you're doing something else. And because the study just wraps the 3 of them in together, then we don't think that you qualify as predominantly manufacturing, more than 50%, even though the study was like 67%. It doesn't really make a lot of sense to me why they reached that decision. One of the things that the court looked at were the agreements, and the agreements obligated them to manufacture these tapes. So for all intents and purposes, this is manufacturing. I would definitely challenge this one if I were the taxpayer too. I don't know. Chris, do you have any reason for why a court would think that that's not manufacturing? I guess it is something beyond. There's advertising, but I don't know the nature of what's on the tape matters.
I didn't understand. The thing that I thought was most surprising was that they got the electricity exemption for manufacturing.
Yeah.
That was the part.
Yeah, that's why you cared about this.
that was the leap that I thought was somewhat interesting.
Yeah.
And what's the most glorious thing about this case? It's a refund claim,
Yeah,
right? They had paid
true.
the tax and they actually got money back.
But you're right. I mean, if states are going to take the position that electricity is tangible personal property, at least we get to take the position that it can qualify for an exemption for manufacturing. So there's a win in there.
Yeah. So with that, I think we've got like 2 minutes left. Anybody have any questions in exchange for swag on anything that we've talked about today, or any insights? This thing feels like it's going on and off. Go ahead, Diane.
So the market tape is based on the
Mm-hmm.
that finds that it was taxable as part of the tax base item, or that it was a taxable.
Just that it was part of the sales price. Yeah. Correct.
If I charge credit card processing, credit card fee, and it's on an item that's sound, then I wouldn't have taxable.
I agree with that. It's just the sales price broadly defines it as no exemptions or exclusions for any sort of expense. And so they couldn't eliminate or remove the price of the credit card fee because, yeah, the underlying item is taxable. It's just whether it can be included within the sales price. Even though it is separately stated, it's still part of what you're selling.
Probably part of the sale.
Yeah.
Anybody else? No? Okay, cool.
Thanks, everyone.
Thanks, everybody.